Hello, once again, I'm Kevin Turner from Real Estate Talk. And through these special broadcasts and by reading Australian Property Investor magazine, we get to meet, talk to, and read about investors who take some pretty big risks as they go about building their property portfolios. But by investing in a wide range of property markets with good growth drivers, has given music conductor Lloyd Edge an impressive $845,000 equity advantage, and he now finds himself in a positive cash flow situation. You can read all about Lloyd's journey in the latest edition of Australian Property Investor magazine, but to give you a bit of a taste about what you'll read there, I'm going to catch up with Lloyd right now. Lloyd, thank you very much for your time.
Hi Kevin, how you going?
Good, mate. That's a pretty impressive amount of equity, $845,000. How did you manage to build that?
Yeah, it's a mixture of using different strategies. One is, I guess, starting with the properties I've got in Sydney, particularly the last couple of years because Sydney's had such good growth. So I had three properties in Sydney, one which I sold last year, but I've still got two there. Most of the equity in the Sydney properties has been gained in the last couple of years because of the growth. And I've got one property that's got over $500,000 equity in it itself, and another one that's got well over 100,000 just there. And one of them was owned for 10 years, so it's been gradually building up over time. Although the market was quite flat for 2004, 2005, it's certainly picked up the last few years, and that equity's built up there. I'm building a duplex at the moment, and that duplex stands to make over 100,000 in equity in that one, basically just by going in, building buying under intrinsic value, and then refinancing, taking the equity out there. And another strategy which I'm using at the moment is buying off the plan. And buying off the plan means that I can just put the deposit down, worry about the finance later, 18 months later. I'm doing this in Brisbane at the moment, be ready in 18 months' time, and there'll be I can make use of the growth that's going to hopefully occur in the Brisbane market over that period of time.
Yeah, buying off the plan, I guess, is always a bit risky. You're doing it in Brisbane. Are there any markets where you wouldn't buy off the plan?
I wouldn't buy off the plan in probably mining towns, and probably wouldn't buy off the plan in regional centres. So if I'd probably stick closer to the capital cities for that. So I'm building a duplex which is actually in a regional town, which is in Armidale, and basically that's for the pure going to that town is not to try to get any capital growth, although the town actually does have quite a good growth rate. But I'm basically just going there just to build and then take the value out of that build. Not so much for growth. If I was going to buy off the plan, where you can get hopefully quite a lot of growth, I wouldn't do that in in an area where there's not going to be strong growth. So I'd want to do that in a place where I can be confident there's going to be some good growth, which I think would be the capital cities, Sydney, Brisbane, and possibly Perth at the moment.
It's a great feature article in Australian Property Investor magazine. There's a lot of information in there, but I was curious to know why you sold the Ingleburn property.
Okay, so when I bought the Ingleburn property, it was certainly not what I do now. But when I bought that, it was not. I didn't have such an investment mind on. I bought it as I already had some investment properties, but I bought that more as a principal place of residence. So it was a nice house. I wanted to live there, but didn't have the best drivers for investment property. So it wasn't close to transport. It wasn't in a great area. And when I moved out of there, when I met my wife and we bought a house together, I rented out the Ingleburn property, and the returns on it were really good. So it worked well as an investment property, but long-term wise, I didn't feel that it was going to be the best investment for making growth. So when Sydney started to make some good growth last year, I decided to sell that, take the profit, the equity that I had in in that property, and then use that profits to put into further investments. And that's helped me to go into some of the investments, some of the properties I'm doing at the moment, which includes a place I just bought in Toowoomba and the duplex. So just using that money to invest elsewhere where I think I can make more money than just having a buy and hold there. And I guess the other thing also, because it was an older property, that's not so, because I do new properties now, which is good for depreciation. So buying an older property, the depreciation is not as good as a new property. So for those are the reasons I thought Ingleburn, nice place to live, that particular house, but get rid of it and then look to buying somewhere else that makes a better investment.
You only invest in cash flow positive properties. Why is that?
Mainly because it's a serviceability sort of thing. So firstly with the banks, if you're trying to build up your property portfolio, the banks are going to stop lending to you if you're negatively cash flowed, if you're digging into your own pocket, because there's only so much that they're going to want to lend you if you're digging into your own pay each week. But I also like to have properties that pay for themselves. I'm not a big believer in negative gearing. I think negative gearing has its place, particularly for really high income earners and they just want to have a big tax break. I find I get good tax breaks with my properties because I'm buying new properties and I get good tax depreciation reports from quantity surveyors, so I get quite a bit back on tax anyway. So I don't really need to be delving into my salary from work to paying for those properties. So I'd like to have the portfolio, be able to pay for itself. And as I said, it's a serviceability thing with the lender. So you go to the lender, you show them your rental statements from the properties, and they're happy to give you finance for another property because what you got is covering your payments and stuff.
You mentioned earlier that you wouldn't buy off the plan in a mining town, but knowing what you know now about mining towns, do you regret buying the Blackwater property, and would you steer away from mining towns in future in total?
I wouldn't. I don't regret buying there. When I bought there, it actually. I think my biggest mistake I've made there is I didn't stick to a strong exit plan. After I bought there, and I bought well below intrinsic value, and I had the place 2 years after I bought the place. For those 2 years, the Blackwater had 23% capital growth. And if I had sold the place then, I would have stood to make quite a lot of money. But I held on to it a little bit longer. I didn't watch the market as closely as what I watch markets these days. What happened after that is that the mining really slowed, and the market started to go backwards. So I've actually just had the property valued by a couple of banks, and there's still equity in it, but not as much equity in it as what there would have been a couple of years ago. So I guess my biggest mistake is I didn't get out of it at the time. I probably, knowing now, I probably wouldn't go into, and I wouldn't advise anyone else to go into mining towns like that. I did carefully choose which mining area to go into when I chose Blackwater, and it actually has fared slightly better than some of the comparable areas such as Moranbah and Emerald. And the other thing I did with Blackwater is the tenants in there. It's not a mining company. It's actually a crane company that hires cranes to mines. So if there's any mining companies that pull out, it doesn't actually necessarily affect my tenants. And I've actually had the same tenants here the whole time. It's 9.1% yield on it, which is very good serviceability for the banks. So there's plenty of positive things about that. But yeah, I guess when I bought there'd been a lot of growth in mining towns, particularly over in Port Hedland, and that was starting to flow into Queensland. So I sort of bought at a time where I felt I could make a bit of money in there. Certainly, I don't go into property for a short-term thing, but this is sort of just a one-off in a mining town to see what I could do there. And but having seen what's happened in the last couple of years, I certainly like to. I'd love to diversify my properties, but I wouldn't go to a single horse mining town. So I'd like to stick around maybe sub-mining towns, places like Toowoomba, Townsville, that they've got mining in those areas, but they're not reliant on mining. So if mining goes bust, then there's plenty of other drivers in those towns to keep the towns afloat.
A lot of very good lessons there for us, Lloyd. I want to thank you for giving us your time and all the success in the future with your future investments.
Thanks very much, Kevin.